Hello and welcome to Who Moved the Market. I'm Surabhi Upadhyay and you might have guessed it already. If you've seen the market right from the morning, the one sector that has dominated the action is IT. And we kind of knew this, right? It was all about TCS yesterday and the numbers are finally out. So over the next 10 odd minutes, I have Reema in the house to help us make sense of what we know has been a miss. Reema, so, first things first, I think this was very clear the moment the numbers came out that this is not looking like a good quarter. But we want to spend the next 10 minutes to understand what's gone wrong, the finer points, and more importantly, the outlook. So thank you for joining in, first of all. Let's start with the basics, the numbers and what you made of them.
Well, the numbers were a miss on the top line and on the margins. So on the top line, the company has delivered a 1.7% dollar revenue growth. The street was hoping for a 2.5% growth. In constant currency terms, the reason we look at constant currency revenue terms is because TCS and other IT companies generate a lot of revenues from other geographies. They generate from America, they generate from continental Europe, they generate from UK, they've got some revenues coming in from India, Asia Pacific, and the movement in all these currencies versus the dollar can also impact the revenues and the growth rate. So which is why we very often look at the constant currency revenue growth rate, because that takes away the vagaries on account of the currency and actually gives you a sense of the demand. Now, constant currency revenue growth of TCS also fell short of expectations. It grew by 0.6%. Now, what basically happened in the quarter is the company said that we were banking on a recovery in North America in the quarter. But due to the crisis in the banking space in the month of February and March, many of the discretionary projects were put on hold. The company said that if this project is not an essential right now, let's just pause it. We will only focus on the projects which are immediate, necessary, and are going to give me an immediate return, where the return on investment is quick. So that's what happened. So the revenues fell short of the management expectation. The management was looking for a 1.5% to 2% kind of growth, but because those discretionary projects were put on hold, revenues came down to just 0.6%. But the costs remained where they were. So the costs are sticky. They had already staffed people in, on-site or in the foreign geographies. So that's the reason why margins, which were anticipated to improve, actually turned out to be flat. So EBIT margins at 24.5% are flat versus the December quarter, and it also falls short of the company's guidance. Now, TCS is a management which never gives you a guidance, but this time they were so confident that they came out and gave you an exit guidance. They said the March quarter margins are going to be 25%. But unfortunately, they couldn't meet that guidance, and margins too fell short of expectation. And on the back of the miss in revenues and margins, brokerages have brought down their growth and margin estimates. So for instance, look at Jefferies. Jefferies said for FY24, we were anticipating margins to come in at 24.6%. It's going to come in at 24%. Kotak also lowered its FY24 margins by 40 basis points from 25.1 to 24.7%. So brokerages have brought down their revenue and margin estimates, and that's driving an EPS cut, hurting the company today.
Okay, and it's all happened in a quarter where the street was prepared for a bit of volatility. But I guess what people didn't anticipate was that it would hit home so quickly. Within just the last 2 months, we've seen this crisis, and it's actually hit home. Which brings me to the question, Reema, is it just US banking that's the culprit, or is there any other segment for the company that's also been sort of a cause of concern? So is it just central and located to this US banking issue, or is it spilling and spreading beyond it?
Well, it's predominantly North America and BFSI, right? Predominantly it's centered there, but the ripple effect is felt across other sectors because generally there is caution. So when you drill it down to numbers, North America degrew. This time, quarter on quarter, North America revenues are lower. Okay. This was not something the street had anticipated or even the management had anticipated, right? Particularly in that BFSI. Now, you don't know what part of where the BFSI decline came through, but BFSI revenues were growing at 12-13% year on year. It came down to 9%. this quarter.
So very
that's
immediate impact
immediate
from
impact, like,
whatever's happened. Though it
as
was
I
just
said, the
two
project.
banks in the US, but the impact has been immediate.
So
And
what
it's
the
here.
management clearly said is, and it's pretty much verbatim, he said there was a rush for capital conservation. Banks wanted to preserve their capital, as a result of which projects and tech budgets were put on hold. And the problem may have been with two banks in the US, but all the others went into a capital conservation mode. There was a rush. Those were the words used by them. But as I said, it's not just US and North America. There were other geographies. Europe, for instance, moderated to a 7-quarter low. So that's another area where you are seeing weakness. And Europe has been, a bit tentative for the last couple of quarters. And I also asked the management that, where else were the discretionary projects put on hold? Yes, it happened in BFSI, to which NGS clearly said in manufacturing and auto as well. So even over there, he did indicate that, discretionary projects are being put on hold. So that's, the big concern. That's where it's happening.
I mean, right now, the bulk of the problem is in BFSI, but there were some red flags, some, pockets
Ripple
of concern
effect, I think.
in the other sectors as well. Actually, tell us more. I also heard the interview that you did with the management, and throughout it, at least the sense that I got was this is a management which is very cautious. It is not guiding the market towards, any sort of a belief that this will be a easy, quick fix and it's just a patch and it'll blow over soon. They sounded, in a nutshell, very cautious to me. But what's your reading?
I think they just sounded so uncertain. They don't know whether the pain is going to be short-lived or it's going to be prolonged. One statement by Rajesh was very telling. He said US clients are very risky. So they take decisions very quickly.
Yeah.
So when things go bad, as they did in the month of February and March, they quickly turned off the taps.
Yeah.
But he said the minute the sentiment turns, American clients are the first to turn the tap back on.
So they'll bounce back quickly as well.
I think that's the expectation.
Yeah.
The problem is right now, they don't have any clarity. It's just uncertain. It's all about the consumer sentiment in the United States.
And
so
we have
more than cautious, I think it was just very uncertain and the demand picture is hazy.
Lack of clarity. And we have the US Fed itself now saying that this banking crisis will lead to a recession. That's what the Fed minutes are telling us. So we need to see whether this was a one-quarter phenomenon or whether this is just the start of what could be a slightly painful patch. Speaking of management, that's the other big piece that's changing for TCS, right? The new man who's coming in, you got a chance to talk to Kriti today. So what is the sense, what is the street expecting on that front, that this is a company that will undergo a change in leadership as well?
Well, there is going to be a leadership change, but there isn't going to be a strategy change. I think they were very clear about it. He says the DNA, all of us have been in the system for a very long time. We may have our own leadership styles, but the DNA remains the same. So there is unlikely to be any immediate strategy change, at all. Right? So I don't think it's going to create too much of any kind of hiccup or volatility. I think it's going to be status quo. But Kriti Vasan, the CEO designate, officially takes charge on 1st of June. Rajesh will be around till the 15th of September to handhold, but he won't be attending the press conference, sitting on the podium over there answering media questions. So he will be around to help with a smooth transition. But as Kriti said, the DNA of TCS since remained the same.
Okay, well, I think that sort of stability is at least something that the market can
hope to expect
and hold on to. So as we're coming down to final thoughts, before I talk about what some of the brokers on the street are saying, and their views are so mixed, what would you say are the most important takeaways? And just remind us of the valuations as well, how the stock is stacking up, considering that IT has been under pressure over the last couple of weeks.
Well, I think today a lot of the froth has, not there was no froth to begin with, but I think a lot of, the gains that they had put in at the beginning of the year, in Q3, the key takeaway was that earnings is not as bad as what the street was anticipating, right? That was the big takeaway from Q3. So stocks had seen a bit of a rally in the month of...
starting January,
at the start, in January and early part of February till SVB and, Silvergate blew up. I think some of those gains are now being taken away. Once Infy comes out with the numbers, we will get, greater clarity. In fact, all the other IT companies, once they come out with the numbers, we will have full picture whether this is, maybe if they provide some more clarity, but it's unlikely, right? Your discretionary project is going to be put on hold. it will be put on hold for the others as well. But
And this is the industry bellwether. This is a titan saying if clients for TCS are taking a very cautious view, and they have big clients, right? Then I guess tier 2 we'll just have to wait and watch.
So in terms of valuations, Infy trades at 21 times forward multiple, TCS trades at 24 times forward multiple. TCS is always traded at a premium to its very large size and higher profitability. Margins of TCS have pretty much been in leadership position when it comes to the front line, large cap companies, plus it's the largest IT company by way of revenues. So that's the reason why it's always commanded valuation premium. But then there are many people who on the street believe that Infy is now consistently growing faster than TCS. For the last 4 years, FY 19, 20, 21 and 22, Infy growth is going to be better than TCS. If that's the case in FY23 as well, should the valuation gap between the two narrow? It's already down to about 15%, but I think that call of valuations, differential between the two is going to keep cropping up.
Well, it's definitely a very interesting end to the fiscal year that sort of TCS has heralded. We really need to see what lies ahead. Before we wrap up, I'll just quickly run through some of the brokerage views on the stock as well, and they are so divided. You have price targets ranging from a low of 2,700, that's JP Morgan, going all the way up to 4,500, which is some of the brokerages on the bull side. So very quickly to run through the names. JP Morgan actually is one of the biggest bears on the stock. The target is 2,700 rupees. And they have actually cut their earnings estimates, revenue and margin estimates by about 1%, a 2% cut on the EPS, saying that this came as a bit of a surprise. This extent of a slowdown and the uncertainty that TCS spoke about at the end of the fourth quarter. Nomura has a reduced rating. Their target price is 2850, so they continue to be below 3,000 as well. Then there is Citi. Citi has a sell call with a price of 3,000. That's about 200 rupees lower than where the stock is trading right now. Citi is also citing similar concerns, saying that valuations are a little high, margins, perhaps the margin expectation on the street will have to be trimmed down as we go forward into the year. Those are the three bears. Very quickly, let me talk about the bulls. You've got three big bulls as well on this stock. First is the Macquarie. Their target price is 4,510. That's a 40% upside from where TCS is currently trading at. They're saying that they expect that the company can actually get back to its targeted margin band of 25% to 28% this year itself. So they're keeping the hope alive. Moving on to the next bull, that's Bernstein. Bernstein has an outperform rating. Target price is 3,560. They're saying that the near-term outlook is uncertain on both North America and BFSI. But they're saying that the order book is still healthy, so let's wait and watch. And this could really tide the company over this slightly difficult patch. Finally, CLSA is a bull as well. Outperform rating, a target of 3,550. They're saying that TCS's structural strength will actually help it tide over this patch, though of course there are near-term headwinds as we've seen from the fourth quarter. So there you have it, the black, the white and the grey of TCS at the end of Q4. With that, we come to the end of this edition of Who Moved the Market. Thank you very much for being with us. We'll see you again next week with another market theme.